Hello, everybody. Kirk Spano, and we are going to talk lots and lots of stuff today. Options management, but really liquidity. And this is kind of going to be a preview to Wednesday night's monthly macro call. So Teresa and Shooter and I will be on Wednesday night to do a real big breakdown of the S&P 500, QQQ, TLT, Bitcoin, all the major markets things. Not really a place to ask stock questions. That's what this one's for. We're going to talk macro and big picture on Wednesday night, but I am going to touch on it today. I finally put kirkspano.com up instead of just redirecting it somewhere. So if you Google my name, which I've checked, my websites don't come up first under my name. So I'm going to try to fix that. I do like that Investing 2020s pops up. All right. Anyway, you can see where I'm sitting today. I am at my seats at American Family Field, formerly Miller Park. As you can see, I can afford the cheap seats. But yeah, I do wait for baseball every year. I retired from baseball from playing 10 years ago, and now I'm shaped like a baseball. But I used to wake up in about this time of year, February, March, and think, oh, I need to find a gym. I need to start throwing a baseball around. I need to get my arm back in shape because I haven't thrown in 4 months. I don't wake up with that anymore. And in fact, I don't miss playing baseball at all. You know why? Because I remember taking a step and a dive to the right, playing third base. I remember breaking up double plays or being the middle infielder and having somebody break up a double play. I remember diving and hitting the ground, sliding. Man, I just want nothing to do with impact sports anymore. I don't like to shoot hoops unless it's horse. I don't even play volleyball anymore. So I want nice, easy things. I like to take a walk. I like to go for a swim. Swimming's good. And yeah, I don't miss playing anymore, but I sure miss going to the park and just watching and hanging out. And I really think that baseball is a game that maybe you go find a kid's game to watch or a high school game to watch or a college game to watch. I don't know if spending big money on big sports, on major league sports anymore, whether it's basketball or football or baseball. I don't know. I don't know how I feel about it anymore. Let's get rolling today. All right. So I am writing an article, M2 liquidity, asset allocation, and hedges during volatility. So that will be out later today. This is kind of my admonition at the start of the article, and I mean it. If you are not trying to wrap your head around what M2 liquidity is and its relationship to asset prices, I truly am concerned about you managing your own money. You might just want to hire me. This is such a basic econ 101, 102 issue that I need you to understand what I'm talking about and why you need to pay attention and why you need to put this above all other considerations when it comes to managing your asset allocation. When the M2 money supply goes down, typically the stock market follows. And then when the stock market believes the M2 money supply is about to go back up, the stock market goes back up. And I have other charts that I did. They're in the chat rooms, and they were in both chat rooms. This is one that we'll look at next. When the M2 goes down, asset prices tend to follow, and sometimes the asset prices anticipate the M2 money supply is going to come down and it leads. So the stock market sometimes leads, sometimes follows. Here's what you should know. This little uptrend here from when it bottomed out, in the last chart I showed you, the United States actually bottomed out here. The rest of the world bottomed out here, which is why this is lower on the global, the four major central banks, Europe, Japan, China, United States. And so those other three central banks had lower liquidity than us because we bottomed out over here. And they started going up before we did. Now, when Janet Yellen was the Treasury Secretary, she had a wall of debt come due, and she financed a lot of it short term. And she did that because the interest rates on the 10 and 20-year treasuries and 30-year treasuries were pushing 5%. So it didn't make sense to her to write long-term debt at what she thought was a higher interest rate. So she wrote short-term debt, and the yield curve was roughly flat. at about the same interest rate, but that was going to come due in 2 and 5 years. Well, now we have a wall of $6.2 trillion of debt coming due, which is the most ever by far over the next, well, through the end of next year. I think into the first quarter of 2027 even. The new Treasury Secretary, Scott Bessent, had criticized, and a whole bunch of Republicans had criticized, why aren't you doing longer term debt? And in my head, from what I can tell, it's because they didn't want to have to deal with it. They wanted it to skip this presidency. Whoever would have won in November was going to have to deal with this. So now Scott Bessent and the Trump administration have to deal with this large wall of debt coming due. And there's a term called crowding out, that economic term, that basically means when the government uses too much of the money, it crowds out business development and construction and other private uses for the money. $6.2 trillion, we have to figure out a way to refinance that. And the problem is that the 10-year Treasury, which has come down lately, is still about 4.3%. So if we refinance to 4.3% over the next 10 years, or 4.5% over 20 years, we have, pretty high interest expense. Right now, our interest on the debt is more than what we spend on defense. If you've been paying attention, what the Trump administration is trying to do, and this is part of what Musk is doing, is just finding ways to eliminate government spending. And I think it's bull in a China shop stuff, but I understand what they're trying to accomplish, at least the rhetoric. I don't know if it's what they're really trying to do. One of the things that Musk just did is he recommended that an entire tech team get fired and that he should probably handle it. Talk about conflicts of interest, right? If Musk wants to close things, he shouldn't be eligible to be the contractor that replaces them, right? That's just managing conflicts of interest. There's plenty of other organizations that can probably do exactly the same thing for cheaper or better than what Musk's team can do, which is not a particularly huge team in the tech world. So they're trying to bring in government spending, but at the same time, they want to kick out twice as much in tax cuts as what they're going to be able to save in government spending. They say they want to save $1 trillion in government spending, but they want $4.5 trillion. So it's actually way more than double, $4.5 trillion of tax cuts. Ronald Reagan, George W. Bush, and Trump in his first term all have tried to say that tax cuts pay for themselves. And they always point to John F. Kennedy. Kennedy did it and it worked. Well, when Kennedy did it, the marginal tax rates were twice as high, literally twice as high than they are today. So when you cut something that is really high, there's usually a positive impact, right? Because it brings spending back. Our tax rates are actually not particularly high. They're kind of middle of the road. Now, I'm not saying that we can't have lower taxes. I do believe that 90-ish% of people should have lower taxes. And when I hear arguments like, half the people don't pay income tax, I'm like, well, good. You really shouldn't pay income taxes unless you're making an above average income. Well, that would mean that about half the people wouldn't. That's logical. So I think that what they're doing is clumsy, and they're breaking things with the idea that if we break it, it'll get fixed better. And I actually agree with that. I do. I actually agree that it will get fixed better, but maybe not the first or second try. So that means that we're going to go through a period of transition. The crowding out that is likely to at least threaten, I don't know if it'll happen, but the threat of crowding out is there. And if you took a look at the numbers that came out today, producers saw higher prices and lower growth. That's a whiff of stagflation. Now, do we actually get full-blown stagflation? I don't think so. But Elon Musk warned us 4 or 5 months ago. He said, look, early in President Trump's term, there's going to be some pain because we have to change the way things have been. And as we know, change, transition is always volatile. People don't like change and transition. They don't manage it well emotionally. And when I say they, I just mean, on aggregate, most people. You guys are elite, so you can handle it. But the reality is that these transitions are painful for a while. And if we do it right, we'll come out of it stronger. I'm not so sure that the way that we're breaking it is going to lead to a long-term positive impact, but I do think it's going to lead to a hyper rally 2-3 years out. I think that the second half of the Trump term, maybe even starting by next summer, is going to be very, very good. I think that we are going to get a speculative blow off top like we did in 2006 and 7, like we did in 1998 and 99. I think that because cutting regulations that are actually mostly good, just redundant and hard to navigate, they could fix it, but instead they're going to throw it out. I remember the two big speculative booms, and really even 2021 was a light version of that. It was fueled by more money, but we're going to get another speculative boom here a couple years out. So when I say buy the dips, buy this correction this year, I mean it. I think that as the new Fed chairman comes in next May, quantitative tightening will be gone, quantitative easing will be on the table, interest rates will be lower, regulations will have been cut, the rules for shorting are getting tougher. So they're basically creating a scenario where things can almost do nothing but go up next year unless we destroyed it somehow. So if we avoid outright destroying everything, probably starting next year sometime, we start to see a mega rally. Now, does it last all the way to the end of the Trump term? I don't know. I think so. I think that they can manipulate it to be that good for that long. However, Jamie Dimon said in 3 years, he said this today, in 3 years, the United States has a debt Armageddon coming. I don't know why he said 3 years. I suppose it has to do with the way that they're refinancing debt now. Because Scott Bessent, even though he criticized Janet Yellen for not extending the debt, he ran his first Treasury auction exactly the same way that Janet Yellen ran her Treasury auction, and he issued mainly 2-year debt, which surprised me. I thought he was going to bump it out to 5. And we had talked about that before. Maybe in the next couple of meetings, the next couple of Treasury auctions, they do push the debt out more to 5 years so they don't have to deal with it as much in the 3rd and 4th year of the Trump administration. We'll see. So I think that's what Jamie Dimon was getting at, is he thinks, look, man, all this debt that we're refinancing now, this year, next year, that means that in 2 to 3 years, we have to do it again. And he doesn't think that there will necessarily be buyers for that debt suddenly. And I think in the back of his head, what he's thinking is what I'm thinking, which means that either we're both really smart or I don't know how to think because, he's a billionaire and I'm not. But we both think, I think that we both think, I know what he knows that he doesn't know that I know because he doesn't know me. But I think he knows what I know is that the rest of the world is unlikely to participate in such a high level of foreign direct investment in the United States. So if the Europeans invest less in America, if Japan invests less in America, if Korea invests less in America, that's kind of something that's tough on us when it comes to money supply, right? So we're probably going to print money by next year somehow. It might not be called quantitative easing. Remember, don't call it QE, call it a special facility, call it repo, whatever you want to call it. I think that there's this 3-step thing that's playing out, and we're in step 1, which is tightening. So that the money supply is probably going to turn over a little bit before they juice it. That's what I think the market is anticipating. It opened way up today. I actually had some sell orders, some trim orders get hit at the open, and then the stocks immediately went down 20 minutes later. So I got probably the best price of the day. And, I guess good for me. I am now over 50% in cash. I also have my hedges on the S&P 500. So I own the 550 SPY puts, means I bought them, right? I don't buy a lot of options. I'm 98% of the time an option seller. When I buy options, I'm really concerned about a downturn or there's some catalyst that I'm waiting to hit to spike a stock up. So while I am chronically buying calls on a Metis, and basically have spent all my profits from the first time we went on that, it's because I expect the India IPO and some other things for Ametis to be very positive this year. But on the broader market, at the S&P 500 level, at the large company level, and even some of the mid companies, I think that liquidity is really going to be a squeeze. And, in the IWM, in the Russell 2000, we know that 60% of those companies are not profitable, right? They're unprofitable, and they probably will almost always be unprofitable. So 60% of the companies in IWM are junk. A handful of the unprofitable companies like Ametis and some of the other ones that we've invested in, will become profitable, and that's where you get your giant S curves and can make 5, 10, 20 times on your money. But the index, it's a crummy index, right? And it's because it's an inefficient market. And I go through this point over and over again. Inefficient markets, you want to be a stock picker. Efficient markets, you can generally be an indexer, because the efficient market is the S&P 500. Half the money gets indexed to it, and then other people are investing in it, and it's kind of quasi-indexing. They don't call it indexing, but if they own several funds, if they're buying the largest cap stocks, they're indexing it. They can claim that they're not, but it's so close to indexing that it's indexing. That's an efficient market. It means that the correlation of the stocks going up and down is real tight. Maybe there's 20 or 30 stocks that are leading on the top and 20 or 30 stocks that are dragging down on the bottom, but those 400 or whatever in the middle, all going to move kind of about the same way. Highly correlated, that's efficiency. In IWM, the skew is just so wide, right? You have companies going to zero and you have companies going to the moon, right? So you don't want to invest in IWM because average on IWM is junk. You have to pick out the ones that you think have a chance of going to the moon, right? That's the popular jargon, to the moon. So when I manage my asset allocation, I'm really talking about the more efficient markets. And right now, the efficient markets are in trouble because they are tied to liquidity. And when we take a look at this one, I think I already had it up somewhere. This is in both chat rooms, and it'll be in this article. This is the global index, essentially, from MSCI. And you can see it kind of tracks, this is the liquidity, and this is the index. If this turns over, right, if this goes back down to these lows sometime this year, which I think is, if it's not probable, I think it's highly possible, but I do think that this is going to turn over. And I think the markets right now, this volatility is kind of anticipating that. The magnitude here is amplified. So if this really falls off, the more it falls off, the expanding force, the reflexivity becomes greater. So small moves beget small moves, but big moves beget bigger moves. So as liquidity comes down, if that's indeed what happens, we could get that elevator shaft drop. Now, I'm not really sure what the motivations are of the rest of the world at this point, right? I'm not really certain if the rest of the world is going to try to stick it to us once they get their Ukraine deal, which, it's stupid the way things are going on that. Now, I'm going to digress here a little bit because that's what I do. Russia invaded Ukraine. If you don't understand that, if you deny it, if you try to rationalize it, please quit all of my services and don't try to make money using my advice. I really want you to leave. Russia invaded Ukraine. Vladimir Putin is a criminal. He's a war criminal. He's a thug. He's a thief. That all said, the United States and NATO has screwed up with Ukraine for 25 years. 9/11 really screwed up the fact that we just stopped paying attention and we kind of let the military industrial complex control the way things went. I have said this before, long time ago. Ukraine should have been made like Switzerland. They should have been armed to the teeth, but there should have been an agreement that they wouldn't come into NATO. They would just have the military to do it themselves ahead of time, because then you could have negotiated with Russia and said, look, Ukraine can be a conduit between the East and the West. You can rent Crimea instead of they invaded it in 2014 instead. That there were solutions that could have been made during the George W. Bush, and Barack Obama presidencies that were never made. And now we have this big mess. And I would ask you, President Trump had an opportunity to stabilize things in Ukraine, and he did not. President Biden saw that there was going to be an invasion months before it happened, because our intelligence is that good, and he decided not to rapidly arm Ukraine to the teeth. When Dwight Eisenhower warned us about the military-industrial complex, I think Ukraine is a case study. I think there'll be books about this. It was handled poorly. Now, I don't think President Trump is handling it well. I understand where he's trying to go here. He's trying to get the solution that I just talked about without having to commit anything. And he somehow thinks that we deserve to get paid because we sent the weapons that we were going to decommission, we sent to Ukraine. I mean, this idea that we built brand new weaponry for Ukraine is just ass backwards. When we send military aid and weapons to a country, it's not what we're using. It's what we have sitting somewhere that is going to rust. So they sent that stuff to the Ukraine. They did not send drones right away. They did not send intermediate missiles right away. They did not even send Patriot systems right away, right? They sent second and third tier stuff that was rusting and bullets. So this idea that we're supposed to be transactional here is monumentally, historically ignorant of the facts and the history. And I would point out that President Trump has not liked Vladimir Zelensky, and that's a big thing for him, liking you. You know, he likes to get his ass kissed too. Since 2019, when it became apparent that Trump had tried to lean on Zelensky to get an advantage in the presidential race against Joe Biden. And he resents that he got impeached because of what he did to Ukraine and trying to extort them the first time. So now he's playing hardball with Ukraine when really what he should be saying to Vladimir Putin is get the fuck out, get the zuck out, and then we'll figure something out. He should be playing hardball with Putin. Now, I believe that Biden should have as well. And I thought that the deal should have been cut way before 2014. I wrote about this stuff in college. So the idea that these are new problems is just ignorant of history. And the idea that some of these trolls on the internet who say, well, I'm ex-military and I think that we should do this and do that and you know, screw Vladimir Zelensky and Ukraine, right? Calling Zelensky a Nazi or a criminal is just so ridiculous. So ridiculous. That's like saying 2 guys or 3 guys strong-armed you at your porch, pushed you in, killed your family, and you're a dick for fighting back. Come on. I would ask a question. Russia used to own Alaska. They sold it to us. It was a bad deal for them. What if they came back? And remember, they run their fighter jets right at the border of where they're supposed to, and sometimes they cross into American airspace. Those are tests. What if Russia decided to take Alaska? How would you feel about that, right? So anybody who is more on the Russia side here than the Ukraine side, instead of 100% supporting Ukraine, think about what would happen if Russia attacked Alaska and used the same sort of rhetoric. Well, there's, this used to be Russian. There's like, whatever. How many Russians live in Alaska now? A couple? We have to liberate them. Those are our resources, right? So anytime you see something where they're rationalizing what's going on between Russia and Ukraine, and they're trying to say Ukraine has some fault in this, yeah, probably. But you got to remember, the leadership in the Ukraine, on and off for decades, were Russian plants the same way that they are in some of the other countries in that region. So I'm just asking you to understand that all these things play together. How do they play together? Our allies, our historic allies, are really pissed off at us. And that means that the foreign direct investment, which was at a record the last couple of years, is likely to fall. So not only are we likely to see M2 money supply fall, but foreign direct investment is probably going to get pulled out of US markets. So when I tell you to raise cash, when I tell you to get out of the efficient markets, because when liquidity dries up, they can hit elevator drops. I mean, this isn't speculation. This isn't ideology. This is following the money. There is a reflexivity here. A lot of people around the world are very upset with us. I think probably rightly so, but who cares what I think about that? The fact is that they are upset with us. It doesn't matter what Kirk or you or anybody else thinks about whether they're right or wrong to be upset with us. They are upset with us. That's like being in an argument and trying to prove your point. It doesn't really matter if you're right. The other person's mad. It doesn't matter if you're right. You're not going to get 80 to 90% of the people to change while they're still heated. So if M2 money supply is showing signs of cracking again, if the United States having to roll debt could cause some crowding out like pressures, I don't think it'll be complete crowding out, but it's enough pressure that money at the margin, right, which is what moves price. And then foreign direct investment comes out of U.S. equities and hopefully real estate. I mean, I actually would like to see foreign money come out of U.S. real estate because I'd like to buy some of it. But we are very likely to see a correction this year. Now, I don't know if what we're going to see is 2018, right? Volatility with a little correction, some rebound, and then a bigger correction at the end of the year. I don't know if we're going to see just a 2022 style correction where we lose 18, 19, 20% and then it reverses. And I don't know if we're going to see 2008. All these things are in play. Now, here's the flip side. Maybe there's still enough money out there from COVID to create one more last puff on the cigar and one more rally. And you're going to have to decide, okay, am I more afraid of missing out on a potential rally because there's a little money left there? Or am I more afraid of losing 20, 30, 40, 50% if all these historical factors, which seem to be lining up, actually play out the way that they have in the past? I can't answer that question for you, but I know that I'm about 50% cash and I have a few percent of my money in S&P 500 puts, so that if the S&P 500 takes a 10% correction, I'm pretty profitable on those trades. If it takes a 20% correction, I'm really, really profitable on those trades. Now, the March $550 puts on S&P 500 are about $1 underwater right now. And I'm looking at the market, it's down about 0.5% right now on the day. In the next week, I think it's this week, I am either going to roll those out to May or I'm just going to close them outright, because I don't want to go into the last 2 weeks of the duration, right? Because these will expire on, let me take a look at a calendar here. These expire on March 21st. The last 2 weeks is when time value really falls off a cliff. So this is the third week before. So I'm going to do something with these puts, and I'll talk about it in the article. I'm going to do something with these hedges now. And remember, they're just hedges for me. I'm not speculating on the downturn. I'm just hedging the half of my portfolio that's still long equities. And I've also written all those covered calls, which is unusual for me. And I'm really down to my dozen best ideas, lower risk, bigger upside sorts of things. I'm not reaching for anything right now. And I'll tell you, I feel really good about not reaching for anything. What happens when you reach out for something heavy and you catch it? You can hurt yourself. So I'm trying to keep everything tight. I've gotten better at this over the course of my career. And I like the fact that I only own a dozen stocks right now. My personal account, I own 5, and I have a big slug of cash. Can I miss a 20% rally for that half that's in cash? I can. But if we get a 20% correction, man, I got a lot of money to invest. And here's the reality. If we get a 20% rally, we probably give it all back. So all I'm losing is some calendar space. And that's what I think that people don't wrap their head around, is that if there's a last puff on the cigar, it probably still burns out. It just burns out later. There's really very little downside to holding extra cash, other than maybe you miss a few points to the upside if there's still COVID money and trader money to push things up. I saw 2 people dropped off the call. I hope they just had things to do and they didn't say, screw this guy for talking about Ukraine like that. Told me to get out, I'm getting out. But if they did, I'm okay with that too, I guess. Wow. Teresa talked about the tactical selling that I did last week, and then she put in some charts. So go ahead and take a look at that when you get a chance. It's on both websites. Interestingly, I didn't want to show his name. I'll edit that out. Somebody asked about Pulte Homes, which is a stock that if it bottoms out, I'll be pretty bullish on. They wanted to do a trade in Pulte Homes. What do you notice about this chart? Look at the date. It's a pretty short-term chart, right? So I told him it was a pretty short-term chart. And I said, here's what I think. I don't think it's a long enough time frame. I think that all your charts should go back to December 2018, because that was what? The bottom of the 2018 corrections. And I think that gives you a relevant time frame to work from. You could even go back to the end of 2017, but I think 2018 is probably good enough. I think most of that money is the same money that's being invested today. And so I pulled up this chart and I said, look, if you go back to the end of 2018, you see this was a pretty tight range in here. What is housing? It's a cyclical industry. I'm not saying it can get all the way back down to this red line, but this orange line is very much in play. You can see it from the Elliott waves. This is a measure of the extensions of the fair value gap. Pulte can very easily get into the 60s or 70s. That's where I'd be interested in it. See how it jitterbugged in here? That's a pretty interesting area. So if it gets into this area again and downward momentum is broken, that's probably where you want to buy Pulte. And the reason I put this one up, because people ask about stocks all the time. The reason I'm pointing out Pulte is because I do think that the home builders are going to be a buy if they correct far enough. Because we have to build millions of more houses. And in my head, I think about it from a macro standpoint, and I think that there's a very good chance that they incentivize home building. You know, Kamala Harris wanted to incentivize people to buy a house. Well, if you don't increase the inventory, you're just giving government money to buy expensive stuff and drives the price up higher. If you give government money or tax credits, which is what it shouldn't be a direct payment, it'll just be a tax credit. You say, okay, if you're an individual and you can afford to build a house, a tax credit helps you. If you're a building company and you go out and build a subdivision, you're already profitable and making money, a tax credit helps you. So if they do a tax credit for home building, that'll drive everything in the economy, really, because construction is a big deal. It's one of the biggest industries. Might be the biggest. I don't know. I think tech is biggest, but lots of wide-ranging tech things. So if this comes down in here between these two orange lines, I'm pretty darn interested in buying it. Now, it did get a short-term up signal recently, and that's why he asked about it. But it broke out of its range, right? It's out of its trend. So could it bounce up? It could, but I think it probably hits the trend and comes back down. That's what I think. I could be wrong. The important thing here is that if it gives me what I think, then it becomes a pretty easy buy. This is a difficult buy. This is a hard trade. What do we know about hard trades? They're hard. So I put this one in the drawer and I say, I'll wait. I don't want to deal with this one. But down here, I start to get a margin of safety because it's much cheaper. If it drops 30%, and it ends up having a 60% overall correction, 50, 60, 70% overall correction from the top, now all of a sudden it's attractive because it should get back up here at some point. And that's what this Elliott wave shows. It shows that it should get back up in here, but I think it probably, right, jitterbug down and then back up. That'd be my guess. AST Space Mobile, I keep telling you, buy the dips. Actually, this was the stock I trimmed today at 29 and change at the open, and I immediately put an order to buy it back. Now, I'm not buying it back at this price. I think there's enough volatility and there's enough short interest and there's enough Elon Musk noise and Starlink noise that I think that the stock still corrects more. But I think that you can sell, and this is what we'll finish with, I think you can sell $25 cash secured puts on this. Have a reasonably good chance of being assigned to you. I think you go out to April. So $25 AST Space Mobile cash secured puts. You're going to get $4 or $5 for them probably. So your net cost will be close to 20. I think that's a pretty worthwhile trade. You collect a big income and you get stock in a company that is almost certainly going to be a $50 to $100 billion company on the next bull market. The next real bull market, not last cigar stuff. But the next bull market, 27, 28, this is probably a stock that goes from $7 billion market cap, 30, 40, 50 billion market cap. And it could FOMO to 100 billion, which I think is pretty fully valued when you compare it to American Tower, which is a similar company with 1/3 the market potential. There's a reason why Vodafone, AT&T, Verizon, American Tower, Rakuten, there's a reason why they all bought into this. Cell phone towers in space is a big deal. And that's why Starlink is chasing. The problem for Starlink, and Musk has actually told us that they can't do voice and video to a cell phone until they put up bigger satellites. He said it. And he said, when we have the bigger rocket, we'll send up a whole bunch of satellites at once. So Starlink is 4-5 years behind. The company Global Sat, whatever they are, is behind. It's sending texts from the space satellites, they're all going to be able to do it. But having 4G or 5G connectivity and voice, which is what would be a game changer in the emerging markets in Africa, Eastern Europe, Southeast Asia, right? In those places that don't have it yet. Those 2 to 3 billion people on the planet that don't have broadband. That's a big deal. And that's where AST Space Mobile has years of head start. So Global Star. Yeah, Global Star. All right. Any questions before we call it a day? Looking at the chat here. No, nothing today. Yeah, I would just encourage you to take this M2 liquidity very seriously, because if you're not, then you're just, honestly, you shouldn't be managing your money. You have to think about liquidity. It's the most basic equation, supply and demand, right? Everything is based on supply and demand. Somebody asked about Permian resources. I just put up an article that talked about them. Buy the dips on Permian resources. I gave all my reasons. New Fortress Energy, I think, is dirt cheap. We know that LNG is going to be a 2 trillion cubic feet, or I don't know, there's some big number I cited in the article. LNG is just going to keep growing. People are like, but Biden shut it down. That's just so dumb. It's just so dumb for people to say Biden shut down LNG. No, he didn't. There's all sorts of export facilities that are just finishing up this year and next year, and he stopped issuing new permits for like 6 months. And Trump is gonna, has told FERC to start granting them again. And New Fortress Energy benefits from that, right? But their Mexican plant, New Fortress Energy, is going to be sending, and their second plant, which is being built, is going to send liquefied natural gas all over the Caribbean. And think this through. With these tariffs, what is the incentive for Mexico to send their natural gas to the United States, right? To do those exchanges. They might be better off just selling it to others. And that is where these tariffs are real dangerous. If our trading partners say, we're just going to pivot to somebody else, that could hurt us pretty bad. So when Zelensky said that you guys could feel this, not taking the right side, and then Trump yelled at him, you don't know. Well, the reality is that if your allies stop doing business with you, if they start pivoting away from you, think about how bad that hurt Russia the last couple of decades. I don't think that it would last for us. I think that if we have a recession, we're replacing the government. That's what we do. So I think it all gets fixed in time, but it's time. Could take 10 or 15 years to fix it. And what if the idiocracy votes in another moron? I hate to say it to anybody who voted for Trump, what I really think, because I understand Trump supporters' concerns. But the thing is, and this is why Trump said Bernie supporters should like him, is that there's a lot of people out there that can identify the problems, right? More or less. But solutions to fix problems are difficult. They're complex. And maybe we do need shock therapy because we just weren't, I don't think Biden was a great president. I think he was okay. I don't even think Obama was a great president. I think he was better than okay, but not much. The Republicans spent all kinds of years thwarting him. And honestly, I don't know where Republican or the Democratic Party are in 5 or 10 years. If they don't turn away from the extreme elements, if the American public keeps being so easily swayed by propaganda and superficial stuff, I don't know how that works out. It tends to work out over time, but how many times do we have to get punched in the gut? So my opinion of President Trump is that he's at a point in history where he has the power, at least until next year, to accomplish a lot of positive things if he can see them and then does them. I don't think he's gonna. I hope I'm wrong. I really do. And I think if there's enough pressure on him, he might pull the trigger on a couple of ideas I've talked about. We'll see. But there is no doubt that he's properly identified the deficit as a problem, right? There's no doubt. He's right about that. Is he fixing it? I think they're in break mode right now. They're trying to break it right now so they can fix it. And I don't know how those fixes turn out. I know markets hate the transition. So, none of the other companies, I don't need to talk about these companies every week. So all the other companies that I'm in. And I'm in for the same reasons that I've been in. Nothing really changes month to month. A little bit here, a little bit there. You're watching their execution over time. So when somebody says, hey, what about this? What about that company? Ask a more specific question. What I think, I'm telling you what I think. I'm not going to regurgitate something that I've said 20 times, though. So ask a more specific question than how about this, or how about that, or what about this, or what about that. I understand what you're getting at, but go to that next level of questioning. Say something like, is the tax system in Malaysia really that beneficial to Enovix? And the answer is yes, right? How does Rocket Lab stack up against SpaceX? Well, in the environment of Musk fatigue and a rapidly expanding space market, the number 2 and 3 players are probably going to do very well. Rocket Lab is number 2 or 3. And always remember what I've said about price and market cap. Think about your companies in terms of market cap against the potential total addressable market, TAM. Just looking at, 27, 22, 29. What does that truly tell you? Convert that into market cap every single time. You have artificial intelligence now where you can say, what is the projected total addressable market for launches and satellite and right all the things that Rocket Lab is in? You can go to Perplexity and ask. Put it on deep. You're gonna want to pay the $200 a year for the good one, and then you put it on deep search. And 2 minutes later, it's going to give you a research report that says this is roughly the total addressable market according to McKinsey and this guy and this guy and this firm and that place. Research isn't hard to do anymore, so we have to learn how to ask the right questions. And I will tell you, the reason I have a job is because most people don't know how to ask the right questions and they're over emotional. If everybody was unemotional about their investments and asked the right questions, which all derive from follow the money, I would just go back to putzing around in my garden and managing my own book. But for now, I got a job. All right. Have a good day. I'll get this edited pretty quick. On Wednesday night, we're going to talk all the macro, and I'll have a few extra charts for you. And Scott and Teresa will give you the technical views. All right, everybody, have a fantastic day.